The broadcast is now starting. All attendees are in listen-only mode.
Hello, everyone, and welcome to today's webinar. I'm Nick Zulovich, Senior Editor at Subprime Auto Finance News and BHPH Reports. Welcome to today's webinar, Hold versus Sell. Is holding your notes more profitable than selling them in Buy Here, Pay Here? Where we're going to learn more about this topic from Randy Spradlin, the Vice President of Sales with Defi Exchange and Defi Solutions. But before we get started, I wanted to go over a few housekeeping items for today's webinar. Please make sure you've dialed in using the phone number provided in your communication email, or you're able to listen to us via your PC speakers. We are recording today's webinar, and we'll make the recording and presentation available to you as soon as possible. You'll be in listen-only mode for this webinar, but we will reserve some time after Randy's presentation for a Q&A session. You can submit your questions at any time through the questions box on the GoToWebinar control panel. And if we aren't able to get to your question today, don't worry, because we'll forward it on to the team at Defi Solutions so they can respond back to you directly via email. And lastly, if you have any problems during our webinar, please click on the hand icon to alert a member of our team. So with years of experience under his belt, let's get right to Randy Spradlin for our webinar. Randy, take it away.
Well, thank you, Nick, and hello, everyone. We'd like to thank you for joining us on today's webinar. So today we're going to talk about hold versus sell, which buy here, pay here model is right for you. And to be honest, we're just going to kind of scratch the surface today just to kind of get some thought processes out there. But we'll go over a quick table of contents right quick just to give everyone an idea of what we're going to cover today. Sorry about that. Had a little bit of delay on my slide transition there. So I'm going to spend a minute today just to talk about what Defi Exchange is, and then we're going to move on more to the meat of the subject matter today, which is hold versus sell, which buy here, pay here method is most profitable. And then also we'll review the top 10 attributes lenders use to review, select, and price your portfolio. And then we'll finish things up, as Nick discussed earlier, with a Q&A session. All right. So what is Defi Exchange? Well, Defi Exchange is basically an auto loan portfolio marketplace that connects both buyers and sellers. In terms of the sellers, it's a very simple platform to use. Whenever they're ready to sell some of their notes, they simply log in, complete a questionnaire about their portfolio, import their portfolio data, which can be done through a direct upload from some DMS systems. And then they have the option to either publish it to the public marketplace or submit it directly to select lenders in a private submission method. Now, what sellers get out of this in terms of what their benefits are, immediately upon publishing their portfolio to the exchange marketplace, they're instantly able to see which lenders their portfolio qualifies for and which lenders it did not qualify for. They'll also be able to see that they've got multiple buyers competing to purchase their portfolio. They'll also be able to track and monitor all offer activity and do side-by-side offer comparisons, and you have the ability to rehash offers and negotiate the final terms directly with the buyer. And all of those benefits are free with zero obligation. Now, what's in it for buyers? I noticed there's some buyers that are on today's meeting, so we'll touch real quick on some of the features that are there for buyers. And basically, we have two tiers for our buyers. Both tiers can access portfolios on the public marketplace. Both tiers have user-configured queues, so they can set up filters in terms of determining what portfolios will actually populate into their queue based off what criteria they're looking for. Both tiers are able to export the portfolio data out into their systems, and it's always in the same consistent format. And then both tiers also have the ability to rehash directly with the seller. Our buyers that use Tier 2 also have the ability to receive portfolios via private submission. They also have the LOS integration, which provides automatic portfolio loan selection based on their underwriting guidelines. And the users can configure the underwriting policies and pricing strategies to auto-decision each loan in the portfolio. It's also got inbuilt LOS verifications module and the ability to book loans systematically, as well as the ability to use third-party data providers like primary bureaus, alternative data providers, and evaluation sources and things of that nature. So over the years, prior to founding sellyourbook.com, which became Defi Exchange now, I had been in the indirect space and had worked with primarily independent dealers all across the country, and it was a pretty even spread. I had about half my dealers that held some notes in-house if they didn't do buy here, pay here 100%, and the other half of my dealer base typically just used secondary lenders and did indirect financing at the point of sale. But one of the things that it was a question that I would always get from a lot of the buy here, pay here dealers when I would go in and talk to them about various programs that were available to help them with financing their customers. And it really didn't seem to matter what part of the country I was in. It was the same question from dealerships that really didn't know each other. And, over time, I thought, that's a pretty good question, and I really didn't know how to answer it. And that question was, why would I sell my buy here, pay here notes and give away all my profits or give away all the interest? And I can't tell you how many times I actually had heard that exact question, maybe phrased a little bit differently, but it was pretty much the same question across the country. And so I got to thinking after time, is that true? Is selling their notes really giving away all their profit? Is it really more profitable to hold their notes than it is to sell them? So in order to kind of figure that out, I thought, well, first I need to create a spreadsheet so that we can look at and compare some different things. And the different things that we would have to compare and things you need to take into consideration when you're comparing holding your notes versus selling them is your cash flows, as well as your profits, what your capital requirements are going to be, and then exactly what your ROIs would be, holding your notes versus selling your notes. So using an Excel spreadsheet, I built out the following assumptions to take into consideration so we could compare, your average deal that you held in-house versus the average deal that you held in-house for a certain amount of time and sold. So some of those assumptions and the assumptions that we have to use are, what's your cost of vehicle? What are you selling the vehicle for? What are your taxes? What are your tag, title, registration fees, and any other miscellaneous fees you may have associated with the deal? What were your GPS costs, reconditioning and transport fees, after you bought the vehicle from the auction? And then also what you were taking in as a down payment, what your average APR was, and then what your average term was on your typical buy here, pay here deal. And then some other things you may want to look at as well is how many loans per month you're going to finance in-house. And then add to that, what do you expect your repossession rate to be? And then if you were to sell your accounts, what percentage of principal do you expect to earn on the sale of your portfolio? And so by taking all that information there, we basically are able to structure your typical buy here, pay here deal based on whatever assumptions you wanted to input. And so, for example, we'll go ahead and move into a assumption for holding a deal in-house. And here are some of the numbers that we used. The sales price is inclusive of your tax, tag, title, registration fees. And so we'd say total sales price was $7,700 on a deal. And if you took $1,000 down on that particular deal, which I know in buy here, pay here, you're going to shoot for more than that. But in this example, we'll say you got $1,000 down. So your amount finance ended up being $6,700. Now, let's say your total cost, with the vehicle costs, the taxes, any other fees, recon costs and all that, we'll say you had $4,600 in that car when you put it out on the street. But you took $1,000 down payment. So your true initial investment in the buy here, pay here deal is actually $3,600. So if you structure that deal to where you've got a $300 a month monthly payment and you structure that deal at 30 months, then your total payments, assuming the customer pays and they don't miss any payments and they pay full term, your total payments on that deal would be about $9,000. And that gives you a total profit potential of $5,400, which is really good profit potential on that. But because you had $3,600 initially invested in that deal, it would take you 12 months at $300 a month just to break even. And so you don't really turn positive cash flow until month 13. But your ROI at 24 months is pretty impressive. That's on 100% ROI. And your ROI at 30 months is even more impressive at 150%. So when you look at these, you say, yeah, holding is definitely more profitable than selling the notes. So let's go and actually look at the same deal structure figures on a sell assumption and then we'll do an actual comparison side by side and maybe look at how you can increase wealth if you did choose to sell some. So using the same $7,700 sales price, the same $1,000 down payment, we've got the same amount financed, vehicle cost, initial investment, monthly payments the same, terms the same. But the difference here is we were able to take in 2 payments. So let's say we collected the first 2 months of payments. So initially we had $3,600 in this car. After the first 2 payments have been collected, now we've got about $6,000 left in this car. Our remaining principal about that time, at about 90 days out, is going to be about $6,300. Now, if we were to sell that account for 70% on the dollar, then we'd end up getting around $4,400 for that deal. Now, we still got about $3,000 in it at that time, so we'd only make about $1,400. And the kicker is it would really only take us about 3 months to break even and turn a profit. So you might be thinking, well, in the other case, it was a much higher ROI if I held my notes versus selling them. So in order to really make that assumption, we want to line these up side by side and do a little bit more of a comparison on those. And so to start with, we will look at holding your notes. So at 3 months, obviously, you don't expect to be broke even on holding your notes on your typical buy here, pay here deal. In this example, you were actually negative 83% ROI. At 12 months, as we discussed earlier, you're breaking even. You've collected 100% of your investment back, and anything from that point on is profit. 24 months, you're at 100% ROI, and at 30 months, you're at 150% ROI. So now if we look at the sale, because we sold this account at month 3, we were able to actually collect back 100% of our investment, plus actually make a 39% return on that investment. But if you look at month 12, you might be questioning, well, where did he come up with this 156%? Because we sold the account after the second payment was made on month 3. And the reason for that is simple. Because you broke even and you made a profit right there at month 3, you could actually repeat that process using that same initial investment, a total of 4 times in a 12-month period, which could give you a total profit of $5,600, which would be, $1,400 each time you sold. You did 4 sales throughout the 12-month period. That's where the $5,600 comes from. Now, that gives you an ROI of 156% at 12 months. Now, there's some things to take into consideration here. We can make this look great on paper and say, oh, yeah, it makes a lot of sense to sell. You got a much higher ROI. But you really have to study your own business model and the market in which your dealership's located. For example, if you're in a pretty rural area, like where I grew up in North Alabama, I lived in a town with 1 red light, and there might have been 4,000 people in that town. If you're a dealership and that's part of your market, you're not going to have enough customers feeding your dealership to be able to sell your notes consistently. Maybe you're not able to sell them in this type of repetitiveness 4 times a year. Maybe it's something you look at selling as part of your business model is, once a year or something like that. On the flip side of the coin, if you're at a competitive disadvantage, you've got a dealership either right next to you, across the street, or down the street, and seems to be taking a lot of business from you, really look at their inventory. If you've got a car that's average cost to you is, $4,000 or $5,000, and you're requiring, $1,000 or $1,500 down, but the guy down the street's got his average cost car at $7,000 or $8,000, but he's still requiring the same down payment. Well, if put yourself in that consumer's shoes, if they only got $1,500 down and the payments are going to be roughly the same, they're typically going to buy the more recent year model, more expensive car. It's that champagne taste and caviar dreams, I guess, on a beer budget, for lack of a better phrase. But that's one of the things you could consider, and should you sell as well. And again, this is just barely scratching the surface here. There's a lot of things you want to take into consideration when you're determining whether you should hold or sell. I know several dealerships out there that do a combination. If it's a deal that they can't break even in within 12 months or have a good ROI within less than 12 months, they'll typically sell them. Cars that they typically can break even in less than 12 months, they would typically hold those notes. And so the short answer is really it boils down to each dealer's independent business model. It can be more profitable if you sell. But again, that boils down to your location, what type of market you're servicing, and then also the type of inventory that you're carrying. And we're going to go over some of that stuff a little bit later. Now I want to just kind of give you an idea of what this screenshot looks like from the spreadsheet that I actually put together. And this is basically that same deal structure we just used. We were selling the car at $7,000. By the time you add the taxes and the tag title registration, that's your $7,700 sales price. You got $1,000 down, so That's a $6,700 amount financed at 24.5% APR for 30 months, and that's where I come up with the $300 a month payment, and I come up with the $9,000. Now, the only difference with this example here is this actually takes into consideration how many buy here, pay here loans a month you're doing and what your repo rate's doing. And then it's just coming over here and comparing cash flows. And if you'll notice where it says capital needed here in the center of the screen, now this isn't how much capital you would need to operate your buy here, pay here dealership. This is if you were going to go buy 10 cars a month at this structure and this cost structure over here, and you were going to finance those at this structure with a 20% repo rate, this is the capital that you would need just for that. Now, we all know that you're not just going to go buy 10 cars and keep them on your lot. You're going to have, hopefully 2 or 3 times that amount on your lot at a minimum in order to be able to, constantly sell 10 a month. So your true capital is going to be more than that. This is just the capital that would be needed to do 10 deals a month in-house. It doesn't take into any consideration any collections costs. So if you have employees to collect those or any type of servicing costs that would be associated with servicing those accounts, this is just looking at the number of loans you're selling a month or you're holding a month in-house and what your repo rate is. Now, down at the bottom is where we just plug in what we thought we would get for those accounts after 90 days. And based on that, we're able to take in that amount of money as a income. And so basically, just to kind of give you the nuts and bolts of the spreadsheet is you basically have 3 income sources. You have your down payment and your payments. If you're selling the accounts, you have your down payments, and then the income from the accounts that you've sold. Now, you have costs that are going out on every car deal. Your costs are your true dealer costs, what you paid for the car at the auction, your recon fees, your GPS costs, taxes, registration fees. Those are all true costs that are coming out when you look at what's outgoing versus what's incoming. And so each month we just build on top of that through the spreadsheet. So this was just an example of where I come up with the numbers out when I was looking at a comparison. And again, just because it works out nicely on a spreadsheet does not mean that that's the case. You'll really need to evaluate your own business models and the markets in which you serve, and the competitive disadvantages you may be at to really determine what's truly the best method and the best model for you as well. All right. Now, if you did decide that you wanted to sell accounts as part of your business model, it's important that you understand some things that you need to consider that if you're going to sell your accounts. There are several things that affect the marketability of your portfolio, which accounts are selected, and the offer amount. Most of these attributes are used to predict portfolio performance, while the others focus on the stability of your business and of its owners and their ability to meet any obligations that may arise in the future. And so we'll actually start going over those top 10 attributes right now. And again, I say these are the attributes commonly used to predict portfolio performance and compliance and assess the stability of the business and its owners to meet the obligations that may arise. And what I mean by that is anytime you sell your notes, most likely there's going to be some recourse attached to that. And so they want to make sure that the owners have the ability to meet any recourse obligations. There's also obligations in getting titles transferred and some of that stuff we're about to go over here with these 10 attributes. But that's mainly what I'm alluding to with that statement there. So first thing that we want to look at is we're going to go over some underwriting. And I know many buy here, pay here dealers don't really have any underwriting, and many lenders actually don't require any underwriting to buy a portfolio. But we are going to touch on some underwriting things that maybe you want to take into consideration and maybe add to your buy here, pay here model, because it could affect how much money you end up getting for your portfolio, the marketability of your portfolio, and even how many lenders might be interested in reviewing your portfolio. We'll also go over the collateral, the deal structure, your loan documents, some compliance things, dealership business model, your reason for selling, the business and the principal's personal credit, and then the due diligence and closing process experience, as well as prior portfolio performance. So to get started, let's dig into the underwriting. So as I said before, some lenders don't have any originator underwriting requirements regarding auto loan portfolios that they purchase, while some lenders may require that you as the originator of the contract have some type of underwriting in place. Either way, it's always a good idea to have some underwriting in place. You'll end up spending less money trying to collect from customers who maybe you shouldn't have approved at the time of sale. And simple items like PTI, which stands for payment to income, or DTI, which stands for debt to income, And even having a minimum income requirement could have a profound effect on the collectability of your portfolio and the overall performance. For example, if you've got a customer making $2,000 a month, some lenders don't really want to see a payment to income over 18%. And so in that situation, you may be looking at a customer that needs to be at a payment of $360 a month or less. So that's just some of the things you want to keep in mind in regards to underwriting. But having underwriting guidelines in place will not only assure that you have better performing portfolio, but it really could make it more attractive to some potential buyers. Next, we'll talk about collateral. And one thing I want to mention is we could do a webinar on each one of these attributes. So I'm barely scratching the surface today. There could be things that I'm not covering, and it's just purely because we just, with time constraints here, we don't want to go too far over our allotted time. But speaking about collateral, this is one of the most important things when it comes to portfolio purchases. For example, each lender has their own methods and pricing strategies that they use to even determine the value of the collateral. Some lenders use NADA, some use Kelly Blue Book or Black Book, some use MMR. They may use those individually, or they may use a combination of one or more of those two evaluation sources. Now, some lenders will go back beyond 10 years, and so it's important to keep in mind, though, that there are far more lenders that would prefer that the collateral be 10 years or newer. So while you do have a handful of lenders out there that'll buy that 12 to 15-year model car, you might be better off if you can keep your cars 12 years and newer, and probably preferably 10 years and newer. And a lot of lenders would like to see that the mileage at the time of sale was 150,000 miles or less. And again, that boils down to the collateral. If it's a Honda Accord, they're going to be much more lenient on higher miles than they are a Dodge Start, for example. And so the actual type of vehicle could really affect how they look at the mileage on that. Certain makes and models, they just don't perform well with all lenders. Though, for example, Unit A may be a great unit for Lender A, but Lender B may have had terrible historical performance out of that particular make and model, so it may not be that good of a model for them. And that's a lot of times why when you're trying to sell a portfolio, you'll see some lenders making offers on certain vehicles, and then you get an offer from another lender and they're looking at completely different vehicles, for example, or different accounts. The units that most subprime indirect auto lenders prefer, I've found, are typically the same units or similar units to those that auto loan portfolio buyers prefer. Now, regarding accounts with salvage and or rebuilt titles, there are some lenders out there that will purchase those, but most lenders really would rather stay away from any type of branded title, which would be fire, taxi, flood, police, salvage, rebuilt. Any type of rebranding on titles could make some lenders a little apprehensive. But with the lenders that will review those and purchase those, one thing you need to keep in mind is when they're evaluating the vehicle, they're going to be using a much lesser value than they would on a clean title vehicle. And some of those could be using vehicle values as low as 50 to 70% of book. So if you're going to carry salvage or rebuilt vehicles and do those in buy here, pay here's with the intentions of being able to sell those off, just keep in mind that there are some lenders out there that'll buy them, but you really need to make sure that you're buying those cars right, because they're really studying the book values hard on those, and they're going to look at 50 to 70% of value in most cases. So just keep that in mind. Another performance indicator that determines how a lender would look at collateral is the past performance of the vehicles. They monitor those by make, model, mileage, and the things that they look at are frequency of repossession, mechanical failure, maintenance costs, frequency of repairs, and they take that information into consideration when they're reviewing accounts to purchase. For example, if they may see that there's a particular make and model where they get an average of 21 months before the car blows up or the account goes into repo status or whatever, if they're looking at that same account on your portfolio and there's 36 months remaining on there, they're probably going to cut in if they make an offer on that. It's really going to cut into what percentage they would be willing to make an offer on that because of their past experience and performance with that vehicle. Another thing to keep in mind when you're out there stocking your inventory is right now we're seeing a rapid depreciation of used car values. So if you structured a deal at 100%, 150% or 200% loan to value within the last 3 months, even though the customer's made some payments, that loan to value right now could actually be exceeding what it was when you actually structured the deal. So that's some other things you want to keep in mind too when you're building these portfolios and you're looking at possibly selling those off, is depreciation of the collateral can really have a profound effect on how much you're going to get for that portfolio. So you want to pay attention to things such as, are there some lease turn-ins that are going to be flooding the market? Are there rental units from any particular make that have flooded the rental car market that are about to find their way into the used car market? And if so, how's that going to affect the value of the collateral? So those are just some of the things that you want to take into consideration when you're looking at your collateral. So now we're speaking about collateral. One of the things with collateral is your deal structure. And while some lenders prefer that each account have had at least 3 monthly payments made, and this goes into the aging, which I look at as part of the structure, other lenders will purchase accounts with only 2 monthly payments made. And then there's some lenders that have programs whereas they'll purchase accounts with no aging. For example, payment stream purchases, or some lenders may, if you've got just a handful of unaged paper and the rest of them have got some pretty good aging, they may include those into the portfolio just to help close the deal. If you're looking to sell your accounts outright, I would hold them for at least 2 monthly payments, and then I would look at possibly selling them off. You may get a little bit more recourse if you sell it at 60 days aging rather than 90 days aging, but it's typically only 1 month more recourse, whereas you may have gotten a 30-day recourse if you had aged it an extra month. If you sell it after aging it for 2 months, you may be looking at 60-day recourse, something else to keep in mind too. Now, back to the deal structure here. First, we're going to go over some terms. And regarding the remaining term, there are lenders that'll buy portfolios with longer terms, but most of them are really prefer terms that are really less than 36 months remaining. Some of them may go slightly higher than that, but very few lenders that I have dealt with really like to see on buy here, pay here paper, really like to see terms, over 48 months. It's I have just possibly a handful of lenders that would even look at that. So that's one thing you want to keep in mind too, is when you're buying your collateral and you're doing your average deal structure, are you going to be able to structure that at 42 or 36 months and still keep the payment and the payment to income in line with the customer? Most lenders also like to see a customer's, like I mentioned before, their payment at no more than 18% of their gross income. And some lenders would actually prefer that be around 15 to 16%, especially on a customer that's making less than $1,800 to $2,000 a month. But the sweet spot seems to be around $300 to $400 a month on payments. I've seen several lenders that would actually decline deals and wouldn't even consider making an offers on them because the payments were over $500 a month. But there are some lenders, depending on the type of vehicle and the type of structure, that would include those as well. But just something I wanted to make you aware of. Now, although many dealerships still do it, most lenders aren't set up to collect from customers on weekly payments. Contracting your customers on weekly payment frequency could limit the number of lenders that would be able to purchase your accounts. Now, historically, we all know why dealerships wanted to contract their customers weekly. So you can keep tabs on them. You can see them every week. But with the explosion of GPS products that are out there, you're able to get that same information on your customer and know where they're at and know how the vehicle's performing without necessarily having to see them every week. And so maybe you want to look at possibly doing a bi-weekly or semi-monthly payment structures and a payment frequency. But again, there are still those lenders that can't buy even a semi-monthly contract. For example, I have some lenders that I deal with that can buy bi-weekly and monthly, but they can't buy weekly or semi-monthly just because of the system limitations on their servicing platform. So those are some things there that you want to take into consideration as well when it comes to deal structure. And so for best results, I think in order to get offers from more lenders, I haven't ever spoke to a lender that wouldn't purchase a contract that was on a monthly payment frequency. And when I first got into the industry, I actually was in collections, and I will tell you that it was far cheaper for us to collect on those customers with monthly payments than it was on those with weekly, because by the time I got the customer's weekly payment, I was already calling them again to get last week's weekly payment. And it seemed like you were doing 4 and 5 times the call volume to collect the same dollar amount. So that's another reason why a lot of lenders look at monthly payments as being a more efficient structure for them in terms of a cost savings when they're trying to service the portfolio. Now, regarding the amount financed, without some underwriting processes being done at the time of origination, few lenders really want to see portfolios where the average remaining balance of each account exceeds around $15,000 or $16,000. Now, obviously, if it's a vehicle that books for $20,000 and they only owe $15,000, I don't know of a lender that would pass on that because that's a good loan to value structure there. But typically, most of these lenders want to see, the balance is under 14, 15 grand. And now there are some that will buy above that, but for best results, I think if you're doing your structures there, you definitely want to keep it under those numbers. Now, because the collateral is such an important role in getting the most you can for your buy here, pay here notes, it's important to keep in mind the following. Excessively high loan to values combined with a high APR and short term can set some customers up to fail just because the payment is such a large percentage of their gross income. So that's one of the things you want to keep in mind. Some lenders or dealerships have told me that they typically like to price their units around native retail because that keeps the loan to value in line and also keeps the customer not only in a payment range that they can afford, but also reduces the trading cycle. So they're able to trade that customer out a lot quicker because it's building up equity a little bit more. Another thing, I have spoke with many dealerships, and 175% of the evaluation value for that vehicle seems to be about average from what I'm seeing for dealerships that structure their buy or pay your accounts. And there are certain dealerships that go up to 200% or more, but there are many lenders that will shy away from certain deals if the loan to value exceeds 200%. Some of them are okay, 200%, maybe a little bit over, but you really kind of limit yourself if you're at that structure. And another thing, again, to keep in mind is as you have these vehicle values, the used car market vehicle values are depreciating, and they expect that to occur more frequently where that depreciation actually increases at a more rapid pace. These could have an effect on your portfolio. And so if you are structured at a little bit lower loan to value, the depreciation of the vehicles don't affect your portfolio as adversely as it would if you were at extremely high loan to value. So just something to keep in mind. I'm not saying that anyone is better than the other. It's, again, something you want to study with your business model and see what works best in your market. But when it comes time to sell them, these are just some things you want to take into consideration. Now, you also want to check with the regulatory department in your state to determine what the max interest rate you can charge is. Most lenders like to see rates no less than 18%, especially on subprime paper, especially deep subprime paper or buy here, pay here portfolios. And typically most of them like to see them under 25%. I've got some that don't mind if they're at 28% if your state allows it. But I would think that the majority of contracts that I see are roughly 24, 25% at max. And again, that varies by state, the credit quality of the consumer, the underwriting guidelines of the loans within the portfolio. But I feel that, in my opinion, it's always a good idea to be a few points below the state max. So next thing we want to talk about are the loan documents. And there are a few lenders that still purchase Rule of 78 pre-computed interest contracts. And there are a few lenders that will still even purchase contracts that are calculated on an actuarial interest method. But most lenders now prefer or only purchase simple interest contracts. So if you're not using simple interest contracts, you could be limiting the number of lenders in which you can sell your auto notes to. Now, I know it may go against the grain of, wanting to hold your accounts in-house and using a pre-computed interest contract, and I get that. But if you're going to consider selling them, it really could open up the door for you to have access to more lenders if you're using a simple interest contract. But again, there are lenders out there that will purchase the Rule of 78 pre-computed interest contracts, so that may not necessarily be a very big deal, but it could limit your exposure on being able to access some other lenders. Now, you also want to make sure that the figures and the collateral on the motor vehicle retail installment contract match those on your buyer's order, your bill of sale. You want to make sure that you have the mileage listed on the buyer's order, even if the unit is exempt. That way, at least the lender will know what the actual mileage is. A lot of times when I see data come across and it's got exempt in terms for the mileage, they don't get an offer on that loan. So it may be if you don't list it on your odometer statement, but you just put it in the system so that you've got it there should you ever want to sell the account. That's good information for the lenders to have, and you'll definitely see a larger number of accounts getting offers on those as well. It's also a good practice to make sure that you go back through all the documents and make sure they're signed by all parties and in the correct places along with all dates. I've had several portfolios that get to the due diligence process only to find out that the consumer signed where the dealership was supposed to sign, or vice versa, or there was a signature missing and stuff like that. So, take the extra minute just to go through there, make sure your people go through and make sure that all the signatures are in the correct place and all your numbers match up and everything. Now, it's also a good practice to get an updated credit application, or at least updated information at least every 3 months. Having updated information with correct documentation will greatly expedite the due diligence process and closing process, which will get you your money a lot faster when you get these accounts over to a lender that's looking at buying these accounts from you. In some cases, when you're talking with your customers and they come in and give you updated information, you may input that information in the notes somewhere in the DMS system, but if it's never documented on the credit application, or if it's never documented within the actual field within your DMS where you would put an updated phone number, if you export that data out to submit it over to the lenders, regardless of which process you use, a lot of times that updated phone number is not going to be included in that data, because that data from your DMS is pulling from the phone number field. And so unless it's updated there, the lender may not get the updated number, which means when they start to do their phone verifications during the due diligence process, they're going to have a lot of bad numbers, which is going to slow down your verification process and your due diligence process. And ultimately, it slows down how long it takes to get your money. So just one of the things you want to keep in mind when you're getting these updated contact information from your customers about every 3 months. Now, in some cases, lenders may submit a revised offer to you because of something they see on a customer's credit application or based on the customer's pay history. That is to be expected, especially if there are excessive late fees or frequent payment extensions or other items that may raise concerns from the lender that they weren't able to see on your original data export. Because once you do this data export, it really doesn't give a lot of historical loan performance information detailed like an actual pay history would be. So just keep in mind there could be accounts that that they initially make an offer on that they don't make an offer to buy once they start the due diligence process, simply because of historical tardiness in terms of their payments or for some other reasons. So it's just good to keep that in mind. It's also a good idea to make a digital folder for each one of your customers so that you can scan all those loan docs too in that digital folder. And so basically you have a digital folder for each one of your customers. Then should you ever get in a situation where you want to sell the accounts, you're not making copies of everything. You're basically just sending the bank the link to the digital folders, and they're able to access those documents without you having to then stop what you're doing and do a whole bunch of copy and paste and stuff. All right. So we're going to talk about compliance next, and I'm just going to shoot you guys straight. I'm not well versed in compliance, but I know it is becoming extremely expensive and extremely important for every dealership. And so I thought we might as well talk about it. It is one of the things that a lot of lenders are looking at, and they're heavily scrutinizing these days. So you want to make sure that all your documentation is compliant and meets all regulatory requirements. And you also want to make sure that your paperwork's up to date, and that you followed all compliance and regulatory laws concerning the sale of the vehicle, as well as the financing of that vehicle. The reality is that even if you sell off your accounts at the point of sale to an indirect lender, you are the originator of the loan and have directly extended credit terms to consumers. You want to make sure that you've been compliant in all of that. Now, I've seen many deals come to a screeching halt because the sellers were using credit application that's been photocopied over and over for the past 20 years. And it's not only barely legible, but it's also missing a lot of important disclaimers and updated language that needs to be on the credit application for the customer to grant permission for any investigation that needs to be done into their credit worthiness and or job or residence verification by the loan originator, which would be you, the dealership, at the time of sale. This means that it typically does not meet the compliancy requirements in most cases, but whether that compliance is due to some governing body or the covenants of that lender's credit facility is irrelevant. The fact remains that it has caused many deals to unwind in the 11th hour. So you want to make sure that the retail installment contracts you're using are up to date. And the great thing these days is that a lot of these DMS companies now have plain paper contracts, and those are typically maintained by the DMS company and updated often. If you're unsure, make sure you check with your DMS provider to make sure those are updated and are compliant in the states that you're doing business in. Now, getting compliant credit applications, retail installment contracts, buyer's orders, and odometer statements used to be a problem. But like I said, now that they're printed on plain paper, it makes it much easier. But it's really a good idea to take inventory of all of your required forms, those that reside outside of your DMS system at least once per year, and see if any of them need updating. And again, we're barely scratching the surface here on compliance. I'm not a compliance guru by any means. I'm probably one of the most ignorant in compliance, and I'll be honest with that. But there are companies out there that can help you keep up to date with compliance and regulatory issues. So if you have any uncertainties there, don't chance it. It's a good idea to go out and reach out to some of those companies and just get up to date with all the compliance that you have to adhere to these days. Now, the dealership business model is what we're going to cover next. And, lenders may have many questions when trying to understand your business needs and your business model. Some examples of what potential portfolio buyers want to know are: how many units do you sell a month? How many of those are buy here, pay here, cash, or outside financing? How long has your dealership been in business and at the current location? Do you put GPS units on all your deals? Are there any third parties that need to be paid off at closing? Does your dealership have any underwriting criteria that must be met to be approved for a loan? Based on this information, many lenders can craft an offer to meet your specific needs. For example, if you have 100 accounts to sell, would you prefer to sell 70 of them at 70% or 40 of them at 80% on the dollar? Lenders really want to know if you're looking more for, like a volume bid offer where you can sell more of accounts and maybe at a lower percentage rate, or if you want like a prime selection where they select fewer accounts, but they pay a premium for those accounts. And so that information is really helpful for these lenders when they're trying to price a portfolio and submit an offer that works for you. Now, the reasons for selling, which is the next section we want to go over, this is just to kind of extend on what we were just talking about there with your business model. They all want to know, why are you looking to sell? Have you sold before? Who do you typically sell to? And again, this falls back to, are you, for example, I had a portfolio the other day. The dealership's looking to buy some real estate. There's a certain dollar amount that he needs to get to in order to do that. And that's really helpful for these lenders because they're not going to waste his time or their time if they don't see anything there that they can make an offer on to get him where he needs to be. And so that's why it's important to try to provide that type of information to these lenders when you're looking at selling them. Now, for example, if you'd really like to sell your whole portfolio because you're opening a second location, the lender's just not going to want to waste your time to submit an offer on 30 to 50% of your accounts. Now, another not so nice product or topic, but we have to cover is the business and the principal's credit. Because most offers come with recourse and because the acquirer of your portfolio becomes the holder in due course, all potential buyers will want to know that your business and that you personally will be accountable should any obligations arise after the acquisition. Such obligations could be for accounts that default during the recourse period, or accounts that titles haven't been received on, or for some other reasons. UCC filings, tax liens, and such can also affect whether you're able to sell your portfolio or not. For example, if you take out a business loan and a UCC is filed, some of those UCC filings cover all of the business assets, meaning that you would need their permission to sell any of your assets. Well, the accounts within your portfolio are assets, and they fall under that filing. I've seen deals almost fall apart right at closing because of that exact issue. So those are some of the things that you want to take into consideration there in terms of the business and personal credit. Now, moving along, we want to walk through the due diligence and closing process. Now, if you've sold to a lender multiple times, one of the things that they look at is, how smooth is the due diligence and closing process been with your business? Lenders may base future pricing of your portfolio partially on their experience during the due diligence and closing phase on a prior purchase they've made from you. There are things that you can do to help make the process smoother for not only them, but also for you as well. Now, once you've accepted an offer, it's a good idea to let your customers know that their accounts are being sold and to expect a call from the finance companies. Customers are much more likely to take that call and complete that interview if they're expecting the call. You want to make sure that your customers know when and where to begin making their payments once the acquisition has been completed. These two things alone will have a huge impact on the number of deals that clear the due diligence process, while also greatly reducing the number of defaults during the recourse period. Now, keep in mind, buyers initially rely on the data provided during the review and pricing process when starting their due diligence. Because this data isn't always updated, items like phone numbers and work numbers are not always up to date. Same goes for credit applications. Updated contact info is oftentimes input to the collections notes and updated within the account details, but it doesn't always export out with the other data, and it isn't on the credit application. So the communication and responsiveness are extremely key during the due diligence process. So providing the initially required documentation to the buyer, along with collecting any missing documentation or steps that they need in a timely manner, that'll go a long way and ensure a smooth transition. And the flip side of the coin is if the lender's reaching out to you to get documentation or to get documents signed and you're dragging your feet, they will look at that in the future when they're looking at your portfolios. They may not even make an offer if they've not had a good experience, just like you wouldn't accept an offer from them if you didn't have a good experience. So those are something that you want to keep in mind when it comes to the due diligence and closing process. Now, we also want to look at prior portfolio performance, because this is one of the biggest indicators on how much you're going to get for your existing portfolio. So, once a lender purchases a portfolio from you, they're going to monitor the performance of that portfolio. It's going to either perform at, above, or below their initial expectations. They're going to take that information into account when they review portfolios of yours in the future. Obviously, if your portfolio performs better than their expectations, then you should see a higher offer and possibly even less recourse on offers you receive from them in the future on future portfolios. On the flip side, if your portfolio performs as expected when they initially priced, then you can expect an offer like what you got originally. Then obviously, if it performs worse than they expected, then you really can't expect anything. You may not even receive an offer at all. And if you do, it's most likely going to be for a lesser percentage than they paid for you on the original purchases that they've made in the past. And the interesting thing is if you continually sell portfolios to these lenders, certain portfolios may perform better than others. And so you could see this fluctuate a little bit. But it's also a good idea when you're talking with these lenders to maybe get some pointers for them on things that you could possibly do to have better portfolio performance in the future, which could tie back into the first thing we covered here, which was the underwriting. So, one second. All right, so that pretty much covers everything for the prior portfolio performance. Now, if you would like to schedule a demo to see Defi Exchange, whether you're a buyer, a lender, a dealership, or even a broker or sales agent, you can visit defiexchange.com, or you can schedule an appointment directly with me at http://meetme.so/Randy Spradlin, or you can give me an email at rspradlin@defisolutions.com, or call me anytime at area code 904-252-4554. And just give you an idea of all of the products that Defi Solutions offers. We have an LOS product, which is used by quite a few lenders in both the deep subprime all the way up to prime and captive companies. We have a servicing platform, Defi Analytics, Defi Digital, Defi Direct, and Defi Exchange. And with that in mind, I'm going to go ahead and turn things over to Nick for a Q&A.
Excellent job, Randy. A lot of great information, a lot of critical decisions that need to be made to answer the question of hold versus sell. And just a reminder that we are recording today's session, so keep watch of your inbox for a message that will contain a link to not only the recording, but Randy's presentation, so you'll be able to go through the material again to help answer those questions that need to be answered before you make a decision. And if you have some questions now, please use the questions box on the GoToWebinar control panel, and we'll get to as many as possible during our time here. And to get us started off, Randy, questions come in. It appears as if it's clarity in reference to slide 11 during your presentation regarding the hold scenario on the buy-hold evaluation. Just how would you typically consider the default probability and associated recovery loss rates? And questions presumably that built into that 70% pricing on a 3-month seasoned note. How would you clarify the metrics that are in that example?
In terms of the metrics there in that example, it might be better if we actually look at this screen here and just overlook the 10 and 20%. But really, to get those metrics, I looked at a book value and what I thought a true dealer's cost would be on that book value car, what their average recon cost would be based on some dealerships, as well as what their typical cost with GPS. And that cost is a little high, actually. That was from a lender that uses a certain GPS product. But basically, I then looked at the deal structure. And to be honest with you, the percentage that these dealerships get once they sell their notes, or even finance companies for that matter, it's really going to vary by the type of paper. If there's FICO scores available, what are those scores? What's the remaining terms? What's the aging? How do the loan to values line up? And so basically here we just kind of used an average assumed number that, all right, initially this was a deal that was structured at a 200% loan to value. That down payment was, just under 15% of the sales price, but 21%, almost 22% of what the seller's cost was in the car. And so basically we put those loan metrics in there to make sure that we were structuring a typical deal. And then we just put an assumed 70% in there. The cool thing about this, the spreadsheet though, is you can put any assumptions in there and actually do a comparison of these numbers and go terms up to 84 months if you wanted to look at even, prime paper, for an example. And I hope I answered that question as what he was looking for.
Excellent, very good. And if you have a question for our special guest expert on today's webinar, Randy Spradlin, who's the VP of Sales at Defi Exchange and Defi Solutions, please use the questions box on the GoToWebinar control panel. And another question that's come up, Randy, has been associated with the due diligence and the volume of accounts that might be purchased. Just for an example, if say a lender makes an offer on 40 accounts that an operator might have available, how might the due diligence process unfold in your experience? How many of those accounts typically end up being purchased and going through to fruition? Just what's your experience and observations there?
Typically, I like to use a 50-50 rule. And again, this will vary by the type of portfolio and the collateral and, the metrics. But kind of across the board, I see a 50-50 rule. About 50%, maybe a little bit more, of the accounts that you post will get an offer on them. And if you accept that offer, typically 60% of those accounts, and again, it does vary, would make it through the actual due diligence process to meet the final closing. And the reason and to expand on that a little bit, the reason that might vary is some lenders kind of rely on that recourse, and they may go through the verification and due diligence process with taking everything that you provided them as the gospel, as everything's accurate. And so they may just make sure that they've got a good working number and the customer still got possession of the car and move through the due diligence process pretty quickly. Some of them may be a lot more crucial and a lot more critical and really go through that due diligence process with a fine-tooth comb. I think what you see there in some cases is you could see a higher buyback rate from the ones that included more loans in, that maybe had a little bit more relaxed underwriting guidelines and due diligence process than you would see from those that went through the accounts in a fine-tooth comb. So while the ones that go through the accounts with a fine-tooth comb may not buy as a larger percentage of the ones they made an offer on, what you can typically expect to see is sometimes a lower buyback ratio from those because there was more due diligence done up front. But I typically tell everybody to, just as a ballpark, I use 50-50 rule. It seems to be fairly accurate most of the time that, if a dealer posts 100 accounts, they'll make an offer on 50 of them. And out of that 50, you can figure, roughly 30 or so that actually clear the due diligence process.
And to quickly follow up from that line of thinking, another important question. Bottom line, just how typically is the turnaround to the operator receiving payments on those accounts that end up being sold?
Typically what I see is from the day that you post your portfolio till the day you get a check in your hand, it's about a 30-day process. And again, this would depend on the size of your portfolio. Obviously, the larger portfolios are going to take a little bit longer time to get through the due diligence process. But typically what I see is a seller will post a portfolio for sale. 7 to 10 days later, they've accepted an offer, and it takes them a couple of days to get the paperwork together to get that over to the buyer so they can begin their due diligence process. So now you're a week and a half, approaching 2 weeks by the time that you've accepted an offer, you've got all your documentation packaged and over to the buyer, and then it typically can take them 10 days, 10 business days typically to get their due diligence process. I don't think I've ever had any take over 30 days, even the large ones. The fastest that I've ever seen it happen was about 10 days from the time it was posted till the dealer had a check in their hand. I've seen it happen in as little as 10 days. But I would tell everybody to expect 21 to 30 days, especially if you've got something coming up that you're planning for and you need these funds for. I wouldn't underscore that it's going to happen any less than 30 days, just so you allow yourself some time in there for that. But typically, I would say from the day that it's posted till the dealership has a check in hand, it's a 21 to 30-day process.
The voice you're hearing, that's our special guest expert for today's webinar, Randy Spradlin, who's the Vice President of Sales at Defi Exchange and DeFi Solutions. And if you have more questions for him, please use the questions box, or if Randy, if you could go back to your slide that had your contact information. Certainly Randy is readily available to not only book an appointment to see if the DeFi Exchange is right for you, but perhaps some other questions back and forth on whether you should hold or sell your paper. And another point, Randy, it appears a lot of your presentation revolved around examples with installment contracts that lease here, pay here is starting to gain some more momentum and market penetration. Just what are your observations there about the appetite lenders might have for lease paper, interest in operators getting into the leasing business? Just what are your thoughts there?
Well, it is more difficult to find buyers for lease portfolios. But that being said, there are several that are now starting to create purchasing programs for lease here, pay here portfolios. So I do expect that you're going to see more availability opening up there in terms of actually being able to find a home for your lease portfolios. In the past, I had, I think, 2 lenders on our platform that would buy lease portfolios, and now we're looking to, obviously add more to that. But I agree with you, Nick. I think it's going to become more prevalent in the marketplace, and it's getting the attention of a lot of these lenders, and so they're starting to look at how they can buy these lease portfolios and how to do it right. Because anytime you've got a lender that's going into a new niche like leasing, and they're making that transition from retail installments to now purchasing leasing, there's a bit of a curve there, and so I think we're really around the corner from really seeing some significant lenders there that'll buy that. So for the next probably year or two, I still think it's a challenge for lease here, pay here dealers to be able to sell those notes as easy when you compare that as to how easy it is to sell retail installment contracts. But I do see that on the horizon getting better for these dealerships that do the lease here, pay here portfolios.
Excellent, excellent. Again, our special guest experts for our webinar today, Randy Spradlin, who's the Vice President of Sales at DeFi Solutions and DeFi Exchange. And in our closing moments here, Randy, if you could just recap again how operators and lenders can get involved with DeFi Exchange, the cost structure, and the kind of the timeline to get started and to have accounts bought and sold. If you could just give us a recap of how individuals and operations can get involved with your platform?
Sure. It's really easy to do. You can get started by visiting our website, defiexchange.com. As soon as you get to the web page, there's a button there that says sign up. You just simply click on that, complete the questionnaire. There's a little drop down to select whether you're looking to be a buyer or a seller, sales agent, or in some cases we have lenders that both buy and sell portfolios through there. Typically, once that gets completed, I'll be in touch with you to get your account set up and approved. If you're a seller, once you get your login information, anytime you're ready to get your portfolio posted and get some offers on that and see if it's something you want to move forward with in terms of selling that portfolio, it's really simple. You have login credentials. You simply just log in, answer just a few questions about your portfolio, stuff like, do you have salvage titles? Do you have any payment extensions? What GPS company are you using? How many of your loans have GPS? Just a simple questionnaire like that. Import your data. Once your portfolio data is imported, you can simply just publish it, and that instantly notifies all of the buyers on the platform that there's a new portfolio available. But it also notifies you, the seller, through your dashboard. It lets you know immediately which lenders it qualified for and which lenders it didn't. And again, there's no cost for any of that, whether you choose not to sell a portfolio or whether you sell a portfolio. If you're selling a portfolio on our platform, we've not charged since the day I founded the original company, and we're not charging anything for the sellers now. In terms of lenders, I would prefer that the lenders actually reach out to me directly. They can still complete the registration page on our Defi Exchange website, but I'd really like to schedule a call with the lenders to kind of determine, what they're looking to do and determine which one of those tiers is going to work best for them on the platform, and go at it that way, because each lender is a little bit different in what they're looking to accomplish and how they're pricing portfolios and stuff. And just to give a little insight to that, there's still a lot of lenders out there that use spreadsheets. And so once they get portfolio data from a seller, they have to copy that information, paste it into their spreadsheets. A lot of them have to then go and manually look up book values and alternative data. And it's a time-consuming process, and it's a lot of manual labor. And with the LOS integration that we have with the exchange, all of that stuff can be pre-configured to set up to run automatically. So as soon as a portfolio comes across, they don't have to copy and paste any data. It goes and automatically grabs their valuation source. It'll go grab any alternative data that they need. And then basically, depending on how their rules are set up and how they have their configuration set up, they could even have it not only auto-select the accounts that they want to make an offer on, but actually have it price that out for them automatically too as well. Ultimately what we're looking to be able to do, which is a huge benefit for both the buyers and sellers, is take a process that takes 3 or 4 days and really get that turned down to where it takes less than a day to be able to get an offer back on your portfolio. That's the end game goal right there, is to really speed that process up, make it a lot more efficient for all the parties involved, and really start transacting these things a lot faster and a lot smoother. But any of these methods that you see on the screen right now are good methods to get in contact with me if you have any questions at all about getting set up with us or anything. Feel free to reach out to me in any one of these options.
That's Randy Spradlin, who's the Vice President of Sales at DeFi Exchange and DeFi Solutions. Randy, thank you so much for sharing a lot of great information about an important part of the business process and challenging questions that need to be answered. But sounds like once they are, it can be a very profitable situation for the operator. So thank you so much.
I sure do appreciate it. And again, I thank everyone for taking the time to be on the webinar today.
Again, thank you so much for joining us, and we look forward to having you next time. All the best for continued success. I'm Nick Zulovich. Thank you so much for your time. Have a great day.